The financial manager is really important, has an important role when it comes to the optimization or maximization of the wealth or the fund that is entrusted to him from the investors. Now, why do we have to appoint a financial manager? First, let's try to imagine Apple. Apple has 5.5 billion shares owned by 26,000 owners. There is no a particular person or a particular entity that is or have or has a what they call this one a direct control or a direct direct control of the firm that can manage directly with the firm. So these owners of the Apple has to assign a financial manager doing that. However, it must be done through the votation because since there are a lot of them do owners of the Apple. Imagine 26,000. Okay, so to make it more regular, what I mean to make it more organized, they need like a governing body, which is number one is the board of directors. So the BOD or the board of directors, they are to be voted by 26. So that is one way of delegating the power of the orders to the board of directors. The board of directors now will be the one who will manage the company, but they will not manage it directly. They need to assign like another financial manager or a CEO that will take the responsibility of the uh, managing the wealth from the owners or shareholders. Now, these are the three main tasks of financial manager. Number one is make investment decisions. Second, make financing decisions. Third, manage short-term cash needs. So all of these are involving money. Now we're going to discuss this one by one here. So in making investment decision, this is the only way in order to increase the value of the wealth that is entrusted to the financial manager. So he has the now the power or the responsibility to choose among the investment that will give more profits to the investors. So there are a lot of alternatives that are where to invest. So it could be that they are going to develop some products like that. So just like what happened to the Apple, so there was a time that they have to decide whether to invest in the first iPhone, and so they have to secure if there are some markets like that. So again, they have to make to look forward in the future if the cash flows that are to be generated out of this investment or developing a product will exceed to the amount of the invested capital or money in this particular project. Okay, so that's one. So once that there is a particular a project, particular project where to invest the money, sometimes there's a need for more money in order to finance the project. So in financing decisions, it will affect also the value of the firm, like depending upon the source of the money that are to be obtained, or I mean additional money to be obtained. So it could be from the stocks, or if it could be from the bonds. So that's a another decision that has impact to the value of the existing shares of stocks that are held by the shareholders. So once that the project is run and there are sales already coming, and there are some operating expenses that are to be to be what I mean to be spent. Now there's a need for the short-term cash needs. So part of the financial managers is to secure that the cash is enough in order to run the business and to avoid some interruptions, because once that there are interruptions along the way, it will cut short the profit of the company, and there will be some opportunities that will be missed by the company. So it will affect now with the bottom line of the corporation because of the profit, and also with that will also of course that will reflect directly to the value of the shares of stocks in the market. So if the market sees that there are a lot of interruptions, shortage in the cash, and a lot of profits that they're expecting are now falling behind. So they will now gradually pull their investments that will make the shares of stocks not more entice not not anymore enticeable to the market, so that will make the shares of stocks demands falling, and of course its value also. So all those decisions are to be made by the financial manager with a goal. The sole goal is to maximize the wealth of the owners or the stockholders or the shareholders. Now, well, maybe we can say that there are a lot that every shareholder has a different objective of having their investment in that company. However, the most common objective is to maximize their wealth. So if for example, if developing a new product is one way of maximizing their wealth, so they like it. So if the board of directors are doing that, I mean, that is their direction. So they get now the votes coming from the existing shareholders because they're happy with the decision of the board of directors and also with the financial manager. So what if the financial manager is not doing according to the wishes of the shareholders? So and also the BOD are doing some wrong decisions by hiring a wrong financial manager. Then there might be some changes in the board of directors as to the power. So the shareholders will realize that they need to change to the BOD. So once the BOD is changed, then maybe another financial managers or CEO will be hired just to align with the purpose of maximizing their wealth or the value of their shares according to their wishes. We need to understand also that there are stakeholders in the corporation. So stakeholders is not only limited to shareholders. Employees, suppliers, customers are the stakeholders of the corporation, also the community where the corporation is situated, like for the plant. The community surrounding that are considered stakeholders. So the maximization of the wealth of the stockholders is not only just depending upon the wishes of the stockholders, because there are some interests also that are influencing the company. So if, for instance, for the employees, if they don't like the management and they feel that they're exploited, so they will raise some wages that will demand from him for the financial manager. Otherwise, if they don't do that, then some of the quality laborers or employees might leave the company, and there is an impact to that, to the wealth of, or to the value of the wealth of the shareholders. So that's why part of the financial manager is also serve the interests of the stakeholders. So they need to balance it. It needs to be explained also to shareholders, so that knowing that it will be beneficial also to the shareholders. So let's say if we are going to increase the salaries, might be that the result might be the increase of the productivity of the employees, and it will result to more sales, more production, less cost of the other cost component of the product. And yeah, and that's it.